What was the impact of deregulation on investment banking? Imagine a world where banks could do almost anything with their money, where rules that once kept them in check were slowly removed. That's what happened when deregulation took hold in the banking industry. It started with laws like the Glass-Steagall Act of 1933, which kept commercial banks and investment banks separate to prevent conflicts of interest. But as the 20th century moved forward, those rules began to loosen. Laws such as the Depository Institutions Deregulation and Monetary Control Act of 1980 and the Garn-St. Germain Depository Institutions Act of 1982 allowed banks to expand what they could do. The biggest change came with the Gramm-Leach-Bliley Act of 1999, which officially repealed key parts of the Glass-Steagall Act. This allowed commercial banks, investment banks, and insurance companies to merge into larger, more versatile financial firms. With these new freedoms, investment banks started to do more than just help companies raise money or advise on mergers. They began to trade securities, create complex financial products, and even get involved in commercial banking activities. This meant they could offer a wider range of services to clients and expand their reach into different parts of the financial world. Competition among banks grew fierce, and new financial products like derivatives and securitized assets became common. These innovations made markets more dynamic but also more complicated. As banks grew bigger and more diverse, they started merging with each other, creating enormous financial giants that combined many different services. This consolidation made some investment banks very powerful and influential in the economy. But it also meant they took on more risks. With fewer rules to limit their activities, investment banks began to use higher leverage and invest in riskier financial instruments. This increased their chances of big losses, especially when markets turned sour. The most notable example of this was during the financial crisis of 1987 and again in 1988, and later during the global financial crisis of 2007 and 2008. During these times, the risky activities of investment banks played a significant role in causing instability. When some of these banks failed or needed government bailouts, it showed how deregulation could sometimes lead to dangerous levels of risk in the financial system. Looking back at the history of banking, deregulation marked a shift from a tightly controlled system to one that encouraged growth, innovation, and competition. It allowed investment banks to evolve from specialized firms into large, multifaceted institutions involved in many parts of the financial world. While this growth brought new opportunities, it also introduced new dangers. The lessons learned from these events led to calls for more oversight, resulting in laws like the Dodd-Frank Act of 2010, which aimed to prevent a repeat of the financial crises. In practical terms, deregulation changed how investment banks operated. They moved from focusing mainly on underwriting and advising to becoming broad-based financial firms involved in trading, asset management, and other activities. This transformation reshaped markets and influenced the global economy, showing how changes in rules can have a lasting impact on the way financial systems work.